We had another sell-off day on Wall Street. Today's could very well be labeled revenge of the mega caps, as we saw a lot of those hefty technology-oriented companies that have been carrying this market for months, if not years, really struggle and stumble here today on a comparative basis. Remember, that's a bit different than what we had experienced. Usually we've been seeing the mega caps pulling the whole market up with it, and not everybody participating. Today, not even the mega caps could get things going there. So be interesting to see how things shake out here moving forward if we do lose that leadership. So we'll take a look at all of that price action, see what it means for our posture, where some of our charts have reverted back to bearish postures once again. And then we'll get into our trade application example, where I wanted to focus on a gold mining company that's really struggled in recent months to the point of getting oversold cluster signals, but has recently started a bit of a bounce, and so wanted to see if we could maybe do a counter trend trade with that one back to the upside. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 14th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, go down below into the description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Also gives you the heads up on what stocks are giving you overbought and oversold cluster signals within the S&P 500. We're also heavy users of Twitter. My handle is @BrandonVanZ, and we really appreciate those of you that click like and retweet on these Market Outlook related tweets. Also, always be on the lookout for imposters out there. I've had a couple of Twitter imposters myself, and today David got hit with one, so that's where it always pays attention to, or always pays off for you to pay attention to the handle that we are using. In today's case with David, the imposter used just one T in the last name of Settle, and in my case in the past they had replaced the O with a 0. So they'll do little things like that. Look at the follower count. If they have a very small follower account, it's in all likelihood an imposter account. And remember, David and I are not going to be reaching out to you via direct mail on Twitter to discuss cryptocurrencies or other programs that we wouldn't be associated with Market Scholars. So always have your spidey sense about you, and if something looks a little bit off, feel free to let us know and we can investigate that further. Also, we do have a presence on Facebook. Feel free to join us at that group you see listed in the website in the logo in front of you. All right, let's go ahead and jump into today's trade activity. As mentioned there a moment ago, we did have another sell-off day here today. The S&P 500 was down 0.75% here today, so not quite 1%. However, at one point during the middle of the day, we were down over 1%. Some of you might have been selling puts and things at the market's low there, and we did have a little bit of rally as we headed to the close. You can see that long lower shadow right there. So not quite a 1% pullback by the time it was all said and done, but there was a kind of significant event here today in regards to that S&P 500 chart. You can see with the pullback here today, remember that followed yesterday's sell-off. Yesterday we were still trading above that rising 30-day moving average, and the intermediate posture was still bullish. Notice what happened today. We popped below that moving average. Notice the change in the color of the moving average from green to yellow here. And now notice the background color of the chart changing from green to red. So the color change of the moving average is a result of going from above the moving average to below the moving average, and the change of the background of the chart is as a result of what's happening down below here with this intermediate line on the market forecast technical indicator. Remember, there's hundreds of technical indicators out there. Market forecast is a fine use and a fine example of them, but there's plenty out there. Whatever floats your boat, it happens to work for us in this video here. But if you are looking for that particular technical indicator, you would have to find it on Thinkorswim or other TD Ameritrade products because it is proprietary to them. There are ways that you can then use ThinkScript to kind of decorate the chart, so to speak, since we're in the holiday decorating time of year. You can kind of pretty up your Christmas tree there and deck the halls with your charts with ThinkScript. And so that's what we tend to do here with our charts that we share with our premium members. So that's how we can get the color background to change there upon posture changes. But even if you don't have those ThinkScripts, they do have a basic market forecast technical indicator that you can apply to your own chart to look for posture changes on your own. But in this case, it's easy to see that the background color went from green to pink, and that's because this green line on the market forecast just yesterday was rising between 20 and 80. It ended at 77 yesterday, but today it has pulled back from 77 down to 73. As you can see in the label there, it's falling, and therefore we would view that as a weekly bearish posture. Now, it's weekly bearish because it's still in the upper half of the range, and it's more precarious when the posture is weak as opposed to strong. In other words, if we had a big up day tomorrow, remember, that's possible. We do have a Fed announcement tomorrow. We'll hear from the Fed, and they always have an opportunity to move the markets depending upon how the market interprets their words. But if we did have some sort of major breakout tomorrow and we hit an all-time high, remember, that wouldn't be completely unheard of. It's not that far away. If that were to occur, this weekly bearish posture would then react to that and move back to likely a strongly bullish posture. So anyway, just a heads up, we're back to a weekly bearish posture, but because of the precarious nature of the weekly postures, it could move back to bullish if we have a big push towards all-time highs there. So not a great look for the S&P 500 as we are now stumbling back down below that moving average. I was more optimistic that we would be able to take out that high from back here on the 22nd. That happened to be an important day. I was just looking at the heat map here a second ago, and notice that Microsoft was one of the lighter, or the brighter, I should say, colors of red here. And remember, what that means is that those are the bigger sell-off companies for the day. And I just happened to notice that Microsoft was among some of the steeper decliners of the day. That's a stock we happen to own in my top-down trend trading class. We've owned it for the last year and a half or so. Remember, we bought it in my dividend class back in 2015, but in my top-down trend trading class, we bought it a few months before the coronavirus wipeout. And it just so happens that we doubled our money in Microsoft on November 22nd. That was the same day that the S&P 500 hit its all-time high. But anyway, those of you that have been part of my top-down trend trading class over time will know that we have what's called our coffee can rule, where when a stock doubles for us, we sell half of our shares, thus extracting our original cost basis out of that stock, and then we are left to play with the house's money on the remaining shares. And so just by dumb luck more than anything, it just so happened that the day that Microsoft hit its all-time high was the day that we doubled our money, sold half of our shares, reduced our risk dramatically, and since then Microsoft has not been able to overtake that. And it's been about 3 weeks or so. So it'll be interesting if that ends up being an important marker on the chart, and if it was, then I'm thankful for the rules that we have in that particular class. You'll notice that Microsoft wasn't alone today, however. You'll notice that Intuit, ServiceNow, Salesforce, Adobe, even Oracle, Fortinet, Synopsys, those companies all got hit pretty hard today. You also saw that Apple was down today. Now, it wasn't necessarily a disaster for Apple. It was down 0.8%, but remember, Apple had been on an epic rise here in the last few weeks. It's been a little different than Microsoft. Microsoft kind of sat out the rally in the last few weeks, but Apple has been the reason for the rally in a lot of respects. So the fact that even Apple was down today, not a great look there. We saw Amazon also down a touch today. Google was down, /Alphabet was down. Facebook /Meta was down. If I could find Square /Block, it was down as well. I'm not sure if they're in the S&P 500 here, but it is kind of funny how all of these companies like Google, Facebook, and Square had perfectly good names that everybody knew them for, and now they're all going to try to change their names and just confuse everybody. But anyway, those are the types of stocks that struggled here today. You will notice that there was one patch of green that does exist on the heat map today, and that's largely in your upper right-hand corner there. That happens to be where a lot of the financials are housed. So financials did have a strong day today. In fact, financials was where we spent our energy in my dividend growth investing class this morning. In fact, one of those green boxes there, I won't spoil the surprise, but one of those green boxes you see in the upper right-hand corner there is the stock that the class selected today for our long-term dividend growth investing portfolio, because there are still a lot of great dividend growers out there, and the financials had been struggling up until today. They've been down more often than up, but today was kind of a role reversal of sorts, and actually saw the financials making a nice move. In fact, notice that Berkshire Hathaway, while it doesn't pay a dividend, obviously a company that I follow closely as someone who's gone back to those annual meetings with Warren Buffett for the last 15 years, of course, with the exception of the last couple of years with the coronavirus. But prior to that, I make the annual pilgrimage out there. So Berkshire is a company I've followed for a long time. They took some heat here a couple of years ago when people thought that Warren kind of lost his way. And he's kind of missing the boat, so to speak, and missing the world passing him by. Well, wake up here today, and old Warren doesn't look so bad all of a sudden. Berkshire Hathaway hit an all-time high today at a moment when a lot of high-octane growth stocks are really falling pretty tremendously from their highs. I'm referring more to the kind of the Cathie Wood types of stocks that are out there, the innovative and disruptive growth companies, not necessarily these Apples and Amazons and what have you. Those have been hanging in there relatively well. But generally speaking, I think if you've been an investor in Berkshire Hathaway over the years, you might not be lighting the world on fire, but you must feel fairly comfortable with your position at a moment like this, where the average stock in the NASDAQ composite is down 39% from its all-time high. That was some of the statistics floating around Twitter over the weekend. Think about that for a second. The average stock on the NASDAQ composite is down 39% from its all-time high, yet Berkshire Hathaway is hitting an all-time high today, right? And they're probably not alone. Procter & Gamble, I know, has been doing really well. So, this seems to be a moment where we have a more defensive tone within the market, and market participants appear to have more of an interest in kind of your old school blue chip dividend growth types of stocks. In fact, one of the interesting elements of my dividend growth investing portfolio today is we own 22 stocks in that particular portfolio. And we were up today. We were up this morning when the market was getting hit even worse than the afternoon. So markets were down today, yet our dividend growth investing portfolio was easily up. It wasn't even just a skosh up, it was up quite a bit. And the reason is because a lot of those defensive areas, healthcare with Johnson & Johnson and AbbVie and Amgen doing really well. Those are all great dividend growth companies there. Walmart and Procter & Gamble and Colgate, Philip Morris, and some of those other consumer staples also doing well today. So I think we had that benefit there, but it did feel like a bit of a role reversal type of a day, where a lot of the stronger, growth-oriented names that had been carrying this market really took a back seat today, and the handful of names that did manage some progress today seemed to be of the more defensive tone, including, there's Verizon and then Comcast, which is a company we talked about in one of my classes yesterday afternoon, had a nice little snapback here today as well. So that kind of gives you a lay of the land here for the day. It really wasn't a good day. And going back now over to the charts, you can kind of see why the charts look the way that they do now that you see what happened within the markets with that heat map a second ago. These charts here on this foregrid, on chart 4B, do not look particularly enticing. Now, obviously, if you're a long-term investor, you're going to look for opportunities when markets sell off. So not all is lost when we start seeing charts set up this way. But if you're a more active, short-term oriented trader, these charts do not look overly enticing at this moment in time. Notice that all four of these charts are now trading below their 30-day moving averages, and with the exception of the S&P 500, whose moving average is still rising just a touch, these other three indices are trading below their falling 30-day moving averages. That's a little bit of a different temperature there as well, especially with something like the NASDAQ here. Notice that the NASDAQ has been holding in reasonably well in recent weeks, but with this 2-day sell-off we've had here where the moves have been reasonably strong, right, to the downside. Today was more than a 1% sell-off day as an example on the NASDAQ composite. We now see a pretty obvious change in the charts here, where that moving average color is now red because price is below a falling moving average. And remember, the more that happens and the more that the market gets used to that, the greater chance is that the path of least resistance is to the downside. Remember, this is not a good time of year for that mindset. Typically, this is a seasonally strong time of year. Now, I did notice that the gentleman that writes the Stock Traders Almanac on Twitter did mention from a seasonality perspective here today that there does tend to be a bit of a lull in the first part of December, and typically that turns around on this day. Now, whether seasonality plays out this year or not is anybody's guess, but right now, looking at the charts, it sure doesn't look all that promising. But we'll see. Maybe the Federal Reserve can say some promising things tomorrow and kind of gain some confidence in the markets once again. I think the markets have been concentrating a lot on the inflationary talk that we've been hearing about here recently. So, if Jerome Powell can say the right things tomorrow to suggest that they've got inflation under control as is, then maybe the market can rally. But right now, if you're just looking at it from a technical analysis perspective, it does not look good out there. Notice that the Dow Jones also has that red 30-day moving average. Price is below that falling moving average. Background color went from bullish to weekly bearish on the Dow, just like it did with the S&P 500. Now note that the Dow was actually today's leader. It was still down, but it was only down 0.3%, right? And that's, again, because of what I'd mentioned just a moment ago. A lot of your big blue chip dividend cash flowing businesses are going to be part of the Dow Jones Industrial Average. Yes, it's true Apple is in there as well, but you've got kind of more of your old school, like, JP Morgans of the world that would be in there, along with Procter & Gamble and Walmart and those types of companies. Remember, there's only 30 stocks in the Dow Jones Industrial Average, so there's a decided bent towards blue chip status in that particular index compared to these other indices here. The NASDAQ, I didn't mention it, but it's worth mentioning. NASDAQ, not only was it down over 1% today, but notice the background color on the NASDAQ chart actually went to dark pink. It wasn't just light pink like we see up here with the S&P 500 and the Dow Jones Industrial Average. We went from strongly bullish to strongly bearish with basically the snap of the fingers there. So this is some pretty dramatic movements where 3 out of the last 4 days for the NASDAQ have been pretty ugly, and it's really caused a little bit of wear and tear there on the chart. That is noticeable. Notice even where we're at right now versus where that high was on the 22nd. Remember, that was the same date that the S&P 500 topped out. So the November 22nd time period is going to be an important one as we look back. But notice where the NASDAQ is currently positioned versus that high versus where the S&P 500 is currently positioned versus that high. In other words, it wouldn't have been out of question for the S&P 500 to hit a new high just 2 days ago. Whereas 2 days ago, the NASDAQ was already trading below its moving average, and it's only gotten worse since then. So you're starting to see a little bit more separation in the market now. Those growth-oriented NASDAQ kind of tech stocks are struggling more on a relative basis right now, whereas the blue chips are a little bit more firm. That's quite obvious with the Dow Jones, but it's even kind of showing its way into the S&P 500, because remember, the S&P 500 is kind of a mix of all of that. You got all of those same blue chips that are part of the Dow Jones Industrial Average is also being part of the S&P 500, but the S&P 500 is much more broad than the Dow Jones Industrial Average, so it also contains all of those heavyweights from the NASDAQ composite. So kind of an interesting mix that we're seeing all of a sudden, but I do think it is the blue chips that are allowing the S&P 500 to kind of hold up just a touch better than what we're seeing out of the NASDAQ composite right now. And then what can we say over here with the Russell 2000? It just continues to be a house of pain. It's terrible. I'm sure we'll talk about it again tomorrow morning in my factor-based swing trading class when we discuss the low size factor, but it just looks awful, right? This chart is is death. So whether it eventually kind of comes back to life is anybody's guess, but right now it just looks terrible. There's 4 days in a row to the downside. We're back, of course, to the strongly bearish posture. In fact, notice the difference in the bearish posture on the Russell 2000 versus the NASDAQ's bearish posture. The NASDAQ does have a strongly bearish posture because that intermediate line fell below the 50th percentile. It's at 45 and falling. But the Russell 2000 finds its intermediate line all the way down there at the low reversal zone already. I mean, we are awfully close to putting in an oversold cluster signal, right? We did have one of those back here on December 1st, and we had a nice rally out of it, a nice dead cat bounce. But remember, those are typically reversion to the mean moves that don't necessarily change the trend. The trend was already to the downside, so we had a little bit of a pop back in the Russell 2000, only to give up the ghost in just 4 straight days right there. Now we're all the way back to basically where we were when we had that first cluster, and we almost got another one. If this would have been 19.79 instead of 20.79, that would be an oversold cluster signal there. So be on the lookout for that. Again, with the Fed speaking tomorrow, they have the potential of really shaking things up, both to the upside or to the downside. And if it is to the downside, there's a pretty decent chance by when David gets together with you guys tomorrow night in this video that you're looking at an oversold cluster signal in the Russell 2000. That's how bad the selling has been there, right? And that is completely different than what you see up here with the S&P 500 and the Dow Jones Industrial Average. So Russell 2000 continues to be our laggard. The Dow Jones is actually showing some promise as wanting to be a leader. It's not quite there yet. The S&P 500 is still our leader. Notice its label is at 73 there, whereas Dow Jones is at 67. But there's been a bit more resiliency here recently in the Dow Jones because of its blue chip status versus something that is much more tech heavy like the NASDAQ composite. So I'll be curious to see how that dynamic shakes out here. And remember, that's not necessarily a great thing for the markets. As much as I love the blue chips as a dividend growth investor myself, if I'm asked what would I prefer if I want a healthy bull market, I want those go-go momentum and technology stocks really carrying this market. And we had that for a while, but this does not strike me as that moment in time any longer. So let's keep our eye on that potential baton pass from tech heavy over to blue chips. And let's do our best to kind of skirt through this more difficult period that the market participants have found themselves in. I'm going to come over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these market outlook market outlook videos. Remember, they're found on YouTube, but we tend to promote them most heavily there on Twitter, and we really appreciate those of you that help us along with that effort. Remember, we don't get paid to do these videos. We don't accept advertising or sponsorship dollars or anything like that. We're just giving you our education, but it does take time. It takes about 3 hours out of our day. And a lot of small education businesses like ours do offer a free video, but remember, a lot of them only offer a free video once per week, a weekend video. We are somewhat of a rare small investment education business that offers a free YouTube video on the 5 different trading days of the week. So if you want to continue to support that and encourage us to keep up that pace as much as we can, then we ask one simple thing out of you, which is to click like for us on Twitter. As long as you're willing to support us, we're willing to keep on doing the videos. But if you guys start dropping off on the support of the videos, naturally we can find other things to do with those 3 hours of those days. So anyway, really appreciate the 104 of you that did that for me on Thursday. It made me prioritize this video here today, even though I had a repairman in my house earlier this afternoon. In fact, I found out my dryer has a blown heating element, and we've been building up on the laundry. He was originally supposed to come last week, but we had a big snowstorm here, so he had to cancel originally. He got here today, and it's one of those days where I wish I was a little handier around the house, because he tells me that to replace the heating element with labor and parts and everything is going to cost me just over $500, and it's like, man, I could probably buy a brand new dryer for a little more than that. So it irks me a little bit that I'm paying for a repair on there, but there is the convenience element. He is going to be able to come back immediately tomorrow and fix it. So it is what it is. It just means I got to go make a little bit more money in the stock market, right? But anyway, point is, I did prioritize this video today. This would have been a day where I may have had an excuse not to do the video, but because 104 of you came out of the woodwork and clicked like for me, by golly, I'm going to get her done for you, just like I say that I will, right? I'm going to keep my word on that. So if you guys can continue to click like on these videos, I'm going to continue to prioritize the videos for you as well. So thank you to the 104 that clicked like for me last time around. Also, over here on our website now, the Sector Selector is posted. Now, a reminder that the Sector Selector gets posted on our website weekly on Friday night after all of the weekly candles are set within the stock market. And the reason I'm bringing this up here is not necessarily to obsess over the way that this looks, the way that it looked on Friday when I posted this on the 10th. It's mostly to show you here in just a minute how things are going to shake up dramatically in the coming week if there is no more change between now and Friday. Now, that's a big if, but there is a major amount of shakeup that is taking place in just 2 days' time, which is very rare. Remember, I look at this stuff all the time, and we typically don't get this type of a shakeup. But notice right now, energy, technology, real estate, and consumer discretionary are leading on the Sector Selector. Now, if I were to look at this in real time, remember, I can come on over here to the paper money account and pull up chart 1E. For those of you who are premium members, you can do that as well, as long as you've gone through our chart importation tutorial video. So I'm going to pull up chart 1E, and I want to show you how there is going to be a massive shakeup up at the top of the Sector Selector if there is not some sort of a bounce in the market by the end of the week. Notice that real estate at this moment in time will have moved from number 3 as of Friday up to number 1, the new king on the hill. Notice that utilities will be moving from number 5 on Friday all the way up to number 2. Notice that consumer staples is going to be moving from number 7 on Friday all the way up to number 3. And then technology is going to fall from number 2 down to number 4. Energy is going to fall from number 1 down to number 5. Now, again, I'm jumping the gun a little bit here. It's only Tuesday, but the reason I'm bringing this up here is this is not normal. Usually just 2 days is not going to show you a huge shakeup in the Sector Selector because we're using 3 different time periods to track the statistics of this, the 1 month time period, the 3 month time period, and the 6 month time period. So it is not normal for us to have a wide change in rankings the way that we are seeing right now, but we are going to see a monumental change in the Sector Selector if the current trends that we've seen the first 2 days of the week hold through the end of this week. Now, again, if tomorrow Jerome Powell comes out and says something nice and the stock market erupts higher and those high-octane cyclical areas do really well, then all bets are off. But if he comes out and it's a bit of a fizzle, or if the markets sell off, then I would expect that these defensive sectors to hold true of what we're seeing right here, which is a big jump higher in the defensives, a big jump lower in the compounding growths and the cyclicals. So be on the lookout for that. Another way to kind of see that visually would be to look at chart 1G, the equal weight sectors 12 grid. Remember, that's a little bit different than what we normally show you in this video with the market cap weighted 12 grid. And so as you can see here, we've got quite the shakeup here as well, where the green charts on the board, which are meant to show you the strongest companies from the WAR score perspective. For those of you unfamiliar with that term, WAR is simply an acronym, stands for weighted aggregate returns, where we're looking at those 3 different time periods that I mentioned a moment ago. But anyway, when you're looking at the top 4 from the WAR score perspective right now, we have a big shakeup compared to what we had been seeing in recent weeks and months. And mostly what we're recognizing is that the bottom rung here has a lot of green all of a sudden. Remember, that bottom rung is where you're going to find your defensive sectors, things like consumer staples, utilities, real estate. those are not the most exciting places on planet Earth. In fact, they're usually known for how boring they are, but sometimes boring is beautiful, right? And this is a market that is starting to get very nervous around the more high-octane areas and wants to drift towards those boring areas like your Procter & Gamble's and your Walmart's over here in that consumer staples area. We're also watching Philip Morris very closely in my class because some of you might know we have over a 20-month win streak on the line in my put selling classes. And that stretches out over 100 trades, by the way. And this month, we've got our closest call yet, where if Philip Morris doesn't close above 90 on Friday, we might have our first loss in basically a couple of years. So should be very interesting. Right now, Philip Morris has benefited alongside a lot of these other consumer staples in the last week. Notice how these things have just shot straight up. Right, and that's not, that's a result of the market being nervous. It's not necessarily a good sign that that's happening. It's the market shying away from what it perceived to be growth-oriented investments and then hunkering down in what it perceives to be more defensive areas. So that is a major shakeup. Again, we don't usually look at these charts during this particular presentation, but I wanted to share it with you here this evening because it was so different than what we are used to. We do not see these types of shakeups, but this is a different type of market we're dealing with all of a sudden, where you're looking at the consumer staples literally going straight up in just a week. And at the same time, notice the rolling over of some of your other more cyclical areas like industrials directly above it. Industrials had this big punch lower, a nice little reversion to the mean rally up to its moving average, and now has started to appear like it's rolling over here underneath of its moving average. Same thing could be said for consumer discretionary over here, and we all know about the woes within the the communication services group. We've been talking about that for the last several weeks, but at least in the case of discretionary and industrials, that's a little bit different than what we've been used to seeing here recently, as is what we see in terms of strength on the bottom rung there with consumer staples, utilities, and real estate. So again, those are areas that are starting to benefit as a result of the nerves that are entering into the marketplace. And those are going to be areas that we'll be focusing on in my trend trading classes going forward as well, if they continue to be strong. Remember, we already own tons of those consumer staples and utilities and other defensive areas in my dividend growth investing classes. But that hasn't necessarily been the case in my trend trading class, where other sectors have been in favor. Now those defensives are going to start swinging into favor. We'll probably see a healthy amount of rotation within our trend trading account as well. So stay tuned on that. Remember, I teach that class on Mondays for those of you that are premium members if you want to follow along with our portfolio management there. Let's also take a look at the asset class 12 grid here. Chart 5A, just to kind of get a lay of the land. I tweeted out about the US dollar here a moment ago just because, it looks so darn impressive. It's the chart in the lower left-hand corner. I know some of you that watch this on a phone might have a harder time seeing these 12 grids, but you should be able to at least make out the trend there. And the dollar looks fantastic. Right. We've been talking about this for a while, so as long as this isn't your first market outlook video, this should not surprise you, right? I've been talking about this for quite a long time. I'm sure David has as well. I've also been mentioning that I don't particularly like it when the US dollar is strong. Generally speaking, I've found that stock market trading is a bit easier for the areas that I like to focus on when the dollar's weak. But remember, beggars can't be choosers. We're looking for any sort of signs of life out there in the market, and we're not finding a whole lot of signs of life out there in other areas like commodities or even the foreign stock market. So, one area, if you're trying to hunker down and look for stronger trends, I guess you could go into the currency market, and in particular, the US dollar appears to be stronger than some of the other areas of the world. Now, remember, we're using the proxy of the UUP right here to kind of get a general sense of the dollar. You could also go directly into the currency markets themselves and have the dollar directly against, let's say, the euro or the yen or what have you. But in this case, we can see that the dollar appears to be strong in general right now. And, that might mean that Americans have greater purchasing power if you want to take a trip around the world right now. Of course, with all the coronavirus variants taking place, who knows if international travel is even a realistic possibility for most of us. But nonetheless, the dollar is strong. So if you're looking for stronger charts out there, that's one of the few that I can point out to you. A lot of these other charts look pretty ugly, right? The only other green chart on the board is foreign bonds. The long-term U.S. Treasuries do not look terrible from a chart perspective either, so I'd kind of throw them in there as honorable mention, but I'm not going to put them on the same mantle that I would put foreign bonds and the U.S. dollar, because both of those have the green background colors. But it is true that long-term U.S. Treasuries are also trading above their rising moving average right here, right? And we can't really say that with any of these others, right? Even preferred stocks up here, usually a pretty boring area of the market. They're rolling over below their falling moving averages. The 10-year Treasury yield is rolling over below its falling moving averages. Oil is rolling over below its falling moving averages. Gold is rolling over below its falling moving averages. Bitcoin is rolling over below its falling moving averages. I know I sound like a broken record here, but I'm trying to make a point. These charts look pretty bad, as do the stock market charts that I showed you a little bit ago on the foregrid. So in general, it's been harder to find good-looking trends out there. So one of the few areas is the U.S. dollar or foreign bonds, or as an honorable mention, I think you still should put long-term U.S. Treasuries on your kind of radar. Even if your posture is not strong right now, at least it's still trading above its rising 30-day moving average there. So it's tough sledding out there right now if you're trying to be bullish. Now, having said that, I want to show you a chart that kind of caught my eye here more recently. And the chart is of a relatively unknown gold mining company. It's one of the bigger players out there, so I don't want to make it seem like it's a penny stock or something like that. But it's just that gold mining companies don't have very big market caps these days, and so most of them aren't even in the S&P 500, and therefore we just don't get an opportunity to talk about them a lot. So here's Agnico Eagle. This is ticker symbol AEM. And it caught my eye actually a couple of weeks ago, because as you guys know, I try to pay attention to the oversold cluster signals, particularly on the longer term charts, like a weekly candle chart or even a monthly candle chart. And so it started hitting my radar a couple of weeks ago. And I had one of those moments where I'm like, I learned something here when I was looking at this, because I didn't realize that Agnico Eagle had such a high dividend yield. Many of you know I do focus a lot of my own personal efforts on dividend stocks. Usually you don't think of gold mining companies as being consistent dividend raising companies. You do tend to find gold mining companies as paying dividends here and there, but it's highly inconsistent. Usually as a dividend growth investor, you're looking for consistency. Well, when I pulled up Agnico Eagle on my dividend stair-step chart, which is chart 2A, I noticed that it has those oversold cluster signals that are starting to stack up on the weekly candle chart. So the reason you don't see the normal blue and orange stair steps on this is because they just got to their 5 years in a row of dividend increases. They did have a cut back here in 2013 to 2014, where their dividend went from 22 cents down to 8 cents. Then they spent several years paying that 8-cent dividend, and then another year after that, 10 cents, and then up to 11 cents, and then up to 12 cents, and then up to 20 cents. And more recently, we had actually a really big increase in the dividend from 20 cents to 35 cents. It's nearly a double, right? If it would have been 40 cents instead of 35, that would be a double. So just to kind of put that into context, remember, most stocks that have long histories of raising dividends raise their dividends between, let's say, 5 and 10%. So this was a monstrous increase in their dividend there. And not only that, they now do have 5 years in a row of increases under their belt. So when I go to redo the dividend stair-step charts early next year and then send out all those new links to all of you who are premium members, we will be showing Agnico Eagle as a legitimate dividend growth stock with its own dividend stair-step charts on it. And if that was plotted right now, again, I've got to do a little bit of work in the background to make that happen, but if it were plotted right now, this would be in the blue zone on the dividend stair-step chart. I'm absolutely convinced of it, because this stock has tumbled from 89 down here to 49. And in doing so, now has a whole bunch of these oversold cluster signals that are stacking up here. Now, I still don't know how much I can trust this, right? This is not Procter & Gamble. This is not Coca-Cola. So this is not going to be the first stock you're going to buy as a dividend growth investor. But I do find it to be kind of an interesting situation, one that surprised me because I was not aware of it having grown its dividend for the last 5 years. And then not only that, but to put the cherry on top with that enormous growth of the dividend from 20 cents to 35 cents, has me paying attention at the very least. So I want to keep it on my radar in the years to come. You can see where it's pulled back to, by the way, is approximately where it struggled with resistance back here in the 2017 time period. Some of you understand that concept of old resistance becoming new support, so maybe that could work its way into the conversation a bit here as well. But going back now over to the swing trading chart, chart 3A, now we can see not only is Agnico Eagle giving us oversold cluster signals on the weekly candle charts here that I showed you a moment ago, but also on the daily candle charts, you have some recent oversold cluster signals as well. Reminder that those oversold cluster signals are just simply when the market forecast has all three of its colored lines, the blue, the green, and the red lines in the lower reversal zone on the same day. They're effectively trying to tell you that there has been extreme selling here recently, and the chances of that extreme selling continuing to take place at the same pace in the immediate near future are less than they would be otherwise. Sometimes that results in a pop back higher. Sometimes it results in a stock that just goes sideways. Sometimes it doesn't work at all, right? And what I call the boy who called wolf syndrome, where you keep on crying wolf and no wolf ever shows up, and by the time the wolf actually does show up, nobody is there to rescue you because everybody's sick of hearing you crying wolf. Sometimes that can happen with oversold cluster signals as well. You can see over here they had a whole bunch of those oversold cluster signals in a row before finally the wolf did appear there, and you got that nice reversion to the mean rally right there. So I'm kind of testing the waters here with this one. I wanted to kind of get a little bit more comfort around it before getting excited about it from a long-term dividend perspective. So I'm going to start kind of just dabbling here. Let's date this particular ticker symbol and just feel our way out here with a few dates before going into a long-term marriage type of proposal situation with a long-term investment. So this is my version of dating a ticker symbol here, just testing the waters, throwing out a little bit of a bullish swing trade in this case. So what I ended up doing was buying it off of its bounce here today. Remember, the trade's already done. I sent out the execution notifications and the levels and everything that I used in our Telegram app to those of you who are premium members. So that way you can get that information while the market's still open, as opposed to waiting until today or tonight to do it like everybody else. But in this particular case, you'll notice that we have a nice bounce up and off of that oversold cluster signal. This low was slightly higher than this prior low, so I'm hoping that this will eventually be viewed as a double bottom right here. And what I need to have to happen in this case is for the stock to get up to this level up here, which is a touch below that falling moving average. So I'm not asking a lot out of the company. I just need it to go back up to its moving average. But if it doesn't happen, I do have my stop loss set a few pennies below where it hit a low here a couple of weeks ago. So if it does hit a fresh low, I'll be out of the trade. I'm just testing it right here. If it doesn't, and this ends up being a bit of a reversal here, then I got a chance to make some money to the upside if it does get up to that price target that you see there on the chart. Okay, so that's what I had for you here tonight. Appreciate you checking out the video as always. You guys do a great job helping David and I along with the likes and everything else like that on Twitter. Please continue that. I'll do my best to get back with you with another video on Thursday, as long as you guys are helping support the video there. So again, appreciate you checking out those analysis here tonight. David should be back with you tomorrow. I want to wish you all the best of success with your trades and your investments. Goodbye for now.